Hello everyone and welcome to the Nomad Hedge. In today's video, we're going to ask the question if the market can rally right after the FOMC meeting. I know it sounds weird considering where we are, but we're going to take a look at the 2-year Treasury Yields as well as the S&P 500, and hopefully that will guide us into that. But first, if you're new here, consider subscribing to this channel and hit that like button if you're enjoying the content. Let's get into it. So after the market was surprised by the latest CPI report, it came to the conclusion that the Fed will raise by another 75 basis points instead of 50. Now, as the market sold off following the CPI, many seem to be worried that another leg of selling might occur right after the FOMC meeting, which is understandably valid, but not so fast and not so sure. Here's a cheat of all the Fed meetings announcing their rate hike decisions, and boom, every time that happened, the market finished up higher. In few instances, we even had bear market rallies that followed. I'm gonna show you that later on the S&P chart, but first let's gauge the 2-year. Seeing the 2-year Treasury yields rising this much is absolutely insane and unsustainable, obviously in the short term. Considering how much debt that's been accumulated since COVID, anything above 4% is going to scream alarm bells if this continues for a long period of time. So ultimately, interest payments on these debts are going to cause problems for the US Treasury, and that's just something they don't want to happen. Anyhow, if we gauge the technicals here, we can clearly see a short-term top within a rising wedge formation. A pullback to either the 21 EMA or the 50-day could be on the books, especially if many are flocking to lock in these attractive rates as soon as possible. So what this means is that if the 2-year starts rolling back from those levels, that could be a tailwind for equities in the near term. And looking at the RSI, it's showing overbought conditions on the daily. And if we look at the weekly chart, we're seeing a negative divergence. So keep an eye on the 2-year. Moving on to the S&P and see where we're currently at. Here's a weekly chart, and as we can see, it's currently finding itself within a bullish falling wedge. So if we're going to find support above this low trend line, the first target of resistance would be the 10-week moving average, which is this yellow line here. If then we get a break at above the higher low trend line, we'll need to aim for the 40-week moving average. And if we zoom a little bit inside a daily chart, we can see there's an open gap connecting this low trend line here. The best outcome would be to fill it and then bounce from there. So going back to what I mentioned at the beginning of this video, if we look at previous market action right after an FOMC meeting, we can see that it was followed by rallies averaging around 9 to 10%. Okay, so the first rate hike in March 16 gave us a 10% rally, and the 2 hikes in June and July was followed by a massive runner to the 200-day moving average. So if we look at how we're positioned today, we are right on spot finding critical trendline support within a bullish falling wedge. So things are therefore setting up for a short-term rally. So just to reiterate what I said on the weekly, the first target would be the 50-day moving average, and then we could possibly look towards the 200 again. I think this should only be viewed as a short dead cat and not in the perspective of a new bull market. That's going to be way into the future when the Fed starts cutting rates, not when they're raising them and doing all kinds of QT and stuff. So overall, take things with a bit of caution here, since there are also a few concerning geopolitical events overseas that could completely change the landscape in the markets as well. So just to conclude this video, again, keep an eye on that 2-year Treasury yields. Any pullback here would be supportive of equities. If we can get that in line with the FOMC meeting, that could set the tone for a new melt up when no one expects it. So that was it for today's short video. Thank you so much for watching. Don't forget to subscribe and click that like button if you're enjoying the content. I'll see you guys in the next video. Take care.